We're talking today about why oil is becoming scary at $95 here and the bond sell-off's continuing. What are the implications going to be and why is it important? And then today's trading takeout is going to be on why you need to form a trading community or be part of one. Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. So WTI oil is looking rather scary up at these levels. I think, we're up tickling at $95 here. And this is completely still because OPEC decided to cut the supply. And there's no appetite for OPEC to release the supply just yet either. And it looks like, it's going to be that they turn the pumps on maybe in Q1. But I was actually speaking with an oil market maker last night, and she's pretty negative on the outlook going forward for oil in terms of this supply issue. And she's saying that calls between, I believe it was 120 and 135 on Brent crude were currently making money. They're becoming more in demand, which kind of is quite scary because we're looking at prices here. So we're looking at prices up roughly there, between there and 135. Just about here, okay? Which is troubling, especially for the inflation backdrop, okay? Oil is used mainly in transport. It's used to refine into other petrochemicals, for production, for airplanes, etc., etc. So this will have a real impact on demand, but at the same time, creating an issue with supply side inflation. People are still going to want to have to travel, so they're going to have to still buy petrol, but it's going to be more expensive. What position then does that put the central banks in? Where does that leave monetary policy going forward? We've really, really got to start wondering that if we do start to get up to these levels, which in my view currently isn't out of the question. Now, if we zoom back out, we can see what happened in the great financial crisis. We saw oil, WTI, get up to about 145, almost 150 bucks. It's sort of a similar setup here, in terms of, okay, we had this big run up, which could even be identified here if we were to put it on a logarithmic basis. And now do we tickle up back up to those highs, back up to these prior highs here? Because this is where we're looking at currently. We're looking at 120, between 120 and 135. If we look at a historical chart of this without, including the rolls. So, yeah, I'm terrified currently. I'm really, really concerned about this market. And I think, most people aren't necessarily looking at oil right now. They're looking at the currency pairs because they're falling off. Obviously, currency pairs are very much related to oil and the gyrations. If we're looking at dollar counter pairs, so if we're looking at euro dollar, if we're looking at pound dollar, etc., this is most of the reason as to why they're falling off is because of what we're seeing here in oil, and also the next market that we're going to talk about, which is treasuries. But yes, concerning the question that you have to ask yourself within this current context is, okay, are we looking at a real inflationary headwind here? Right then, so the next market we're looking at is the US bond market. And again, another market I'm pretty terrified about at the moment in terms of where we're headed. Now, the reason why I'm terrified is because we sort of seen all of the destruction occur around here. So we saw destruction occur around there, which was earlier this year with Silicon Valley Bank and Credit Suisse. And this is all due to duration risk. So the issue with regulation since, I guess let's just say after the great financial crisis, is banks were forced to hold high quality liquid assets against as collateral against the other assets that they had that were higher risk. Now, it was deemed that treasuries were very, very, were very low risk. But the problem is that you then get into operational risk that creates this duration risk, it's known as, when treasuries sell off, they become less valuable, and so your collateral pool decreases versus the assets that you hold. Regulatory requirements step in where you need to update that, and you need to, basically buy more. But there becomes a shortage of high quality liquid assets. And this is one of the big problems with sort of the way regulators think about how things work in finance, how things work in the markets. But the problem that we really need to highlight here around all of that is duration risk. And duration risk is, as I said, when treasuries sell off and then they have to be hedged out, over a certain maturity, to prevent price implications, affecting your whole book. You have to be able to hedge out, and they do that via interest rate swaps and other instruments. But the problem here is that the pace of this treasury move currently, so this is the yield, so you can imagine which way the actual bonds have gone. The bonds have gone basically down here while the yield is increasing. The pace of this move has been really, really quick. And I would not be surprised if we start hearing some murmurs around here of more banks feeling the strain. If we were to look at regional banks, this one, you can see that they've had a torrid time as this treasury move has sort of unfolded. This was the Silicon Valley stuff. This was Silicon Valley and the other, was it First Republic, maybe? Can't remember. There was another bank that went under. Silicon Valley, First Republic, and Credit Suisse was all here. And personally, it looks like we're gearing up for another move there. You can see this sort of rounding that's occurred back in the early part of the year. And we've had a similar move with a resultant move in treasuries as well. So I would not be surprised if we see this market tick, and this isn't necessarily something tradable. I would advise you to touch. Shorting ETFs and shorting stocks in general is a bit of a mug's game. You're betting against humanity, in my view. But the way that you probably want to look at this is as a broader indicator. If, for example, you hold a pensions portfolio that is heavily made up of fixed income, so bonds, you might want to think, okay, let's recalibrate this a little bit. Let's go into shorter dated bonds and whatnot. The shorter dated bonds have less duration risk because they mature faster. So you're not left holding the bag, basically. So this is my view on how things are going currently. And the treasury market is very, very concerning for regional banks, again, in the US. It would not be a surprise if we see some more stresses over the coming week or two stemming from this treasury move. So for today's trading takeout, I just really want to highlight the importance of having a really strong community or people to chat to within trading. I mean, trading can be very isolating, especially for a retail trader. And the number one thing to have backing you is those conversations going on all the time. But secondly, I think you saw in the video that I just did that I mentioned I spoke with an oil market maker. I've been on Twitter for many years now, and some of the connections that I have there, I would never have interacted with maybe in real life. So to be able to get the perspective of one of the largest oil market makers on the state of oil at the moment, and then to be able to share it with you guys is pretty special, I think. And I've got many of these. So whenever I need a specialist subject explaining to me, I can go to a bond guy. I can go to, a commodities guy. I can go to a specialist in petroleum, for example. Like, it's so important to build these connections because they do really, really enjoy having them asked about their views and being able to share their experiences. So make sure you always try and be part of an online trading community or group with people that are smarter than you is probably the number one tip here.